The markets hate uncertainty, and man, have we had plenty of that in 2020. Well, to provide some protection as well as some profits, I'm going to share with you the $13 play every investor should know. Hi, I'm Matthew Carr, Chief Trend Strategist for the Oxford Club. Thank you for watching this episode of Market Trends. Now, with all the volatility in 2020, gold has enjoyed one of its strongest rallies in years. Year to date, the precious metal is up roughly 25%, and that's after it's pulled back from those new all-time highs in August of nearly $2,100 per ounce, right? So these are levels gold hasn't hit since the price collapse almost a decade ago. Now, we're in for some more volatility ahead, and there's a lot of ways to invest in gold. Physical coins, bullion, the GLD, which is the Spider Gold Trust, miners, and more. So I believe investors should have exposure to all of those. But I'm going to share one of my favorite plays on gold with you today. Sibanye Stillwater was created in 2012 during the gold price collapse. It was spun off from Goldfield, which was the fourth largest gold miner at that time. But Sibanye wasn't gifted with such promise, right? It was born from three unwanted, old, low growth, and underperforming mines that were plagued by labor unrest, right? But it had an ace up its sleeve in the form of CEO Neil Froneman, who is known in the industry as Mr. Fix-It. So Froneman cut costs by 15% and increased output. Today, Sibanye Stillwater is one of the top 3 gold miners in the world and is one of the lowest cost gold producers, right? So the company also owns the highest grade platinum group metals mine in the world, and it's one of the lowest cost producers in the industry of these metals, right? So these are the features we always want to see from a miner, but it gets better. Over the past 3 years, Sibanye Stillwater's annual earnings have gone from a loss of 38 cents per share to a projected gain of 55 cents per share this year. Now that's a phenomenal turnaround, led by the fact that revenue has grown from $3.5 billion in 2017 to $5.1 billion in 2019. And for 2020, we're expecting a 43.7% increase to $7.3 billion. Now, in the most recent quarter, the company produced more than 147,000 ounces of PGM from its U.S. operations at an all-in sustaining cost of $875 an ounce. But the basket price Sibanye Stillwater received for this output was $1,898 per ounce, right? That's a big spread we like to see. Its gold mining operations produced nearly 289,000 ounces in the quarter at an AISC of $1,316 per ounce. Now that's a big step down in cost from the June quarter, and the basket price it received for this gold was $1,845 an ounce. So these are very strong margins, and they show how the company has grown in recent years as well as become more efficient. Now, here's the benefit and risk of a miner like Sibanye Stillwater versus gold. Year to date, shares have outperformed the GLD. That's great. But we do see the downside in the massive sell-off back in March. That's when the stock market collapsed and everything tanked, even gold miners. So this is an important point to keep in mind. Gold miners are a proxy on gold and can be a very successful one, but they are still stocks and they don't provide immunity from collapses. Sibanye Stillwater is the largest individual gold producer in South Africa and a top 10 global producer. It is now the largest platinum producer in the world, as well as one of the largest palladium miners. And if that wasn't enough, it's also a notable uranium producer. You get all of this for the low price of $13. That's a deal that's hard to beat. Well, I'm Matthew Carr, Chief Trend Strategist for the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's the high returns.